After April 2027, gifting money to loved ones could create a bigger problem than the inheritance tax bill you were trying to avoid. Everyone talks about the 7-year rule. Give money away, survive 7 years, and job done. But that's not enough. Because if unused pensions are brought into the inheritance tax calculation from April 2027, gifting becomes more important and easier to get wrong. In this video, I'll explain the traps, the exemptions people miss, and one key rule. Don't gift without a plan. Welcome back to Money Under the Microscope, where we make finance clear. Now, this video is part of our ongoing Pension Reckoning 2027 series, so if you're trying to make sense of these up-and-coming rules, you might want to bookmark the full playlist, which I've linked below, to catch up on the rest of the strategy. Right, let's get on with the video. Part 1. Why 2027 changes gifting. Before April 2027, many people treated pensions differently. The old logic was simple. Spend the savings, spend the ISAs, use other investments, and leave the pensions alone. For many people, the pensions sat outside of the inheritance tax problem. But from April 2027, most unused pension funds are expected to be included in the inheritance tax calculation. That means some people may have a bigger inheritance tax problem than they originally thought. So, instead of automatically leaving the pension untouched, people may need to consider drawing more pension while alive, gifting gradually to loved ones or beneficiaries, and using exemptions each year. That does not mean empty your pension. It means the pension, estate, and gifting plan need to be looked at together. Part 2. The tax trap. People assume gifting from a pension is automatically clever because it might reduce inheritance tax. But pension withdrawals above your available tax-free cash is normally taxable income. If extra withdrawals push you into a higher tax band, you could pay more tax on the way out. You could pay 40% income tax now to maybe save 40% inheritance tax later. Now that might still make sense, but the maths has to work. Bad planning is creating a tax bill today, giving the money away, losing access to it, and still leaving problems later. Before drawing pension money to gift, ask yourself, what tax does this create now? What tax might it save later? And is the trade-off worth it? Part 3. The care cost trap. The second trap is giving money away you might later need. If you gift £50,000 or £100,000 to loved ones, that money is no longer yours. Maybe it helps with a house deposit. Maybe it gets spent. Then years later, you need care. Costs rise, and suddenly that money would be useful. But you cannot assume you can just have it back. That is not planning. That's just hope. There's also deliberate deprivation. If a local authority believes you gave money away to reduce care fees, they may still treat those assets as if you own them. Before making any meaningful gift, ask, can I afford to never see this money again? If not, then stop. Part 4. Exemptions people miss. The 7-year rule gets all the attention, but some gifts can be immediately outside of your estate if used properly. The annual exemption is £3,000 each tax year. If unused, it can be carried forward by 1 year, so in some cases you may use £6,000. Small gifts are up to £250 per person per tax year, as long as another exemption has not been used on the same person. Wedding gifts can also be exempt, £5,000 to a child, £2,500 to a grandchild, and £1,000 to someone else. But the big one after 2027 could be normal expenditure out of income. Regular gifts made from income, not capital, that do not reduce your normal standard of living. If done properly, those gifts may be immediately outside of your estate. No 7-year clock. That could matter where someone is drawing pension income and genuinely has surplus income. But the important thing here is to keep records. Income, spending, gifts, dates, amounts, and who received them. That's really important. Part 5. What this means for your pension. This does not mean everyone should enter their pension. It does not mean gifting is always better than paying inheritance tax. It means the old logic may need reviewing. Before 2027, many people thought leave the pension alone. After 2027, you may need to compare spending it, gifting surplus income, using exemptions, preserving other assets, insuring against the tax bill, or using a combination. Leaving the pension untouched may no longer be the right thing to do. Gifting can be part of the plan, but only if it's affordable, deliberate, documented, and thought through. Okay, so let's recap. The 7-year gifting rule is not enough after 2027. Done badly, gifting can create a bigger mess than the tax bill you were trying to avoid. You could trigger income tax, give away money you'll later need, create care funding issues, or leave your family with no records. So don't gift without a plan. Know what you can afford to give away permanently, know what tax it creates, know what it means for your future care position, and keep records. In the next video, we're getting practical. How to find every pension you have and what to check before April 2027. If you found this video useful, please like, share and subscribe, and look forward to seeing you on the next one. This is Money Under the Microscope, where we make finance clear.